Tipping for good customer service is an integral part of how some employees in the United States are compensated. In this video, I'll cover how the practice of tipping started, how we define tipped employees, the tip credit, and several examples on how payroll accountants calculate the gross pay for tipped employees. In the late 1800s, tipping became widespread in the United States because wealthy Americans observed the practice of tipping in Europe, where it was a symbol of aristocracy and servitude. After World War I and II, tipping fell out of favor in Europe because it reinforced class division, where only the wealthy gave extra money to lower-class workers. European countries adopted strong labor protections and universal social benefits much earlier and more robustly than the US, and wages for hospitality workers are set high enough to live on without tips. And service charges are often included in the bill, like, for instance, France's service compris, which means service included. In contrast, U.S. employers embraced tipping to avoid paying full wages, especially for workers in the post-Civil War South. The U.S. system evolved to make tipping a wage subsidy rather than a reward. In Europe, some might say good service is expected as part of the job. That said, as someone who has visited quite a few European countries, good customer service may vary widely from one country to the next. In the U.S., tipping became linked to incentivizing good service, creating a different cultural attitude. However, even in the United States, there are differences in tipping. Many restaurants automatically add tips for large groups, and I've noticed that in some cities, like for instance Miami, tips are commonly automatically added to the bill. So what exactly is a tipped employee? According to federal law, a tipped employee is someone who regularly earns more than $30 a month in tips from customers. These tips are not just bonuses. They form an important part of the employee's income and affect how their wages are calculated and reported. We'll typically find tipped employees in industries like food service, hospitality, personal care, and delivery. Think servers in restaurants, bartenders, hotel staff, or even barbers and spa workers. Lately, the practice of tipping or asking for tips seems to have expanded beyond the typical groups. I've seen the tip screen for other service industries as well, and that practice seems to have become a bit controversial. The compensation for these tipped employees is often split between a lower hourly base wage and the tips they earn, and that total forms their gross pay. This structure can make payroll more complex, especially when trying to comply with both federal and state laws. The Fair Labor Standards Act, FLSA, allows for a different set of wage rules for tipped employees, and those rules come with legal and ethical challenges. For example, how do you ensure an employee makes minimum wage if their tips vary wildly from day to day? Let's start with a discussion of what the tip credit is. The tip credit is a core feature of how tipped employee pay is structured. It allows employers to count part of an employee's tips towards meeting the federal minimum wage of $7.25 per hour. Under federal law, the lowest cash wage a tipped employee can receive is $2.13 per hour. The assumption is that tips will make up the rest, up to a maximum tip credit of $5.12. But there's a catch. If an employee's total tips don't raise their earnings to $7.25 per hour, the employer is legally required to make up the difference. This makes accurate tip reporting and tracking essential for payroll compliance. Employers must also inform employees in advance that a tip credit is being applied and meet all record-keeping requirements. Failure to do so could result in legal and financial penalties. Tipped wage laws are not uniform across the U.S., though. While the federal rules allow a $2.13 per hour tipped wage, many states have stricter standards. In states like California, Oregon, and Washington, employers must pay tipped workers the full state minimum wage, no tip credit allowed. Other states like New York and Massachusetts permit a smaller tip credit than the federal maximum. These states might require employers to pay $5 or $6 per hour in base wages to tipped workers. When federal and state laws differ, the employer must apply the standard that is most favorable to the employee. This means payroll professionals must stay up to date on the rules in every state where the business operates, especially for multi-state employers. To calculate gross pay for a tipped employee, you add the hourly wage paid by the employer to the tips the employee earned. For example, Danye is the concierge at a resort in Indiana and receives the standard tipped hourly wage for the state of $2.13. During the week ending June 7th, Danye worked 40 hours and received $130 in tips. So we start by multiplying the 40 regular hours by $2.13, which results in $85.20. To that, we add the tips of $130, and that amounts to $215.20. We divide that amount by 40 hours to double check that the employee has earned at least the minimum wage of $7.25 per hour, which isn't the case. Her hourly rate, including tips, is $5.38 per hour. That means the employer must pay the difference, which is calculated by subtracting Danye's hourly rate of $5.38 from the minimum wage of $7.25, and then multiplying the amount by 40 hours, which is $74.80, which will add to Danye's tip minimum wage and tip wage amount for a total of $290. Let's look at this example where the employee works in Michigan. Destiny is the concierge at a resort in Michigan and receives the standard tipped hourly wage for the state of $3.93. The state's minimum wage is $10.33. During the week ending June 7th, Destiny worked 40 hours and received $130 in tips. So we start by multiplying the 40 regular hours by $3.93, which results in $157.20. To that, we add the tips of $130, and I come up with a total of $287.20. We divide that amount by 40 hours to double check that the employee has earned at least the minimum wage of $10.33 per hour, which isn't the case. Her hourly rate, including tips, is $7.18 per hour. That means the employer must make up the difference, which is calculated by subtracting Destiny's hourly rate of $7.18 from the minimum wage of $10.33 and then multiplying the amount by 40 hours, which is $126, which will add to Destiny's tip minimum wage and tip wage amount for a total of $413.20. Here's another example, which includes the overtime pay calculation. Janie is a waiter at Famous Foods in South Carolina. Janie earns the standard tipped hourly wage of $2.13 per hour. During the week ending October 18th, 2024, Janie worked 45 hours and received $240 in tips. Calculate Janie's gross pay, assuming tips are included in the overtime rate determination. So we start by multiplying the 40 regular hours by $2.13, which results in $85.20. To that, we add the tips of $240, and that amounts to $325.20. We divide that amount by 40 hours to double check that the employee has earned at least the minimum wage of $7.25 per hour, which Janie has. Her hourly rate, including tips, is $8.13 per hour. So now we're ready to calculate the overtime. Janie worked 5 hours overtime, and her overtime rate is $8.13 times 1.5, or $12.20, for a total overtime wage of $61. When we add the overtime to the regular pay, including tips, I come up with a total gross pay of $386.20. Employees are required to report tips to their employer, usually by the 10th of the following month, using IRS Form 4070 or another employer-approved method. These reports allow the employer to calculate withholdings and meet IRS requirements. And employers are required to include tips and gross wages on the employee's W-2, withhold income and payroll taxes from tips, and pay their share of Social Security and Medicare taxes on reported tips. Accurate record keeping protects both employees and employers. If records are incomplete or inaccurate, businesses risk IRS audits, wage and hour claims, or legal action from employees. Many businesses now use digital point-of-sale systems that automatically track tips, but manual tracking is still common, especially with cash tips. Either way, employers are ultimately responsible for correct reporting. I hope this video helped you understand the history of tipping in the United States, who is considered a tipped employee, the tip credit, and how we calculate the gross pay for tipped employees.